Today we're focusing on 4 undervalued Dividend Kings that look to be on sale right now. For those that are new to investing, Dividend Kings are essentially companies that have increased those dividends for a minimum of 50 years, and the reasons why we like adding them into our portfolio. As you can see, they have gone through the really tough times of the economy, whether it's periods of inflation, recessions, changes to technology, consumer taste. It is one of the reasons why we do like considering these in our portfolio. One thing we just want to point out before we take an in-depth look, just because a company is a Dividend King, it doesn't necessarily mean that it is one that will continue to pay dividends in the future. As we can see here, just a list of a few that have in fact cut their dividend, and we have a more recent example of 3M that we have discussed not too long ago on the channel. Now, if you are someone that actually doesn't like to look at individual companies for those reasons, today's episode will also refresh our understanding of the Dividend Monarch ETF, and this is one where if you want to invest in an ETF as a group rather than individual stocks, we can see there are around 30 plus companies that have increased those dividends for over the last 50 years. We're going to take a look at their holdings as well as their performance, as this is a fairly new ETF to consider. So let's jump into the episode. As always, we're going to do an in-depth look at each one of these Dividend Kings, their historical performance, how they've performed, as well as look at the ratings analysis. And we're also going to touch upon their dividend safety, run through some very important financial metrics, their debt levels, their free cash flows, and as always, we will run them into the valuation model, getting to both our intrinsic value as well as our acceptable buy price. We're going to consider our margin of safety as well, and also come to the conclusion of what the implied upside is in terms of Wall Street over the next 12 months. Now, before we do jump into stock number 1, we just want to let you know just a few hours ago we have released our latest free weekly article. We've touched upon 12 undervalued dividend stocks that are high quality to consider for the portfolio. If you want access to this completely free, do click on that pinned comment below. You get instant access to not just that article, but all of these that you see on the screen. For example, if you want to find out how we look at undervalued stocks, all the websites and resources that we use, as well as other articles to note. So the first undervalued Dividend King that we have is AbbVie. Now, this is one that we can see, in fact, over the last year hasn't performed too badly, up 16.6%. If you were to take a look at the analyst targets and ratings, it is a double buy seeking alpha and Wall Street with a hold from quant. We do know pretty much in the midpoint of the 52-week range. It has a fairly nice starting yield, just under 4%, and a forward P of 14.35. Bear in mind the S&P right now is trading around 21.5 on a forward P basis. If you have been a long-term shareholder, well, you would be up 192%. For those that reinvest those dividends, you would be up marginally higher. So let's take a look. First and foremost, dividend safety score, it is A tier. It does look to be safe. Market cap 285 billion. It is a mega cap company, and what we can in fact see, just a few weeks ago it was reaffirmed that their dividend is safe, meaning a dividend cut looks unlikely for AbbVie. So in terms of looking at some metrics, how did they perform in the last recession? Well, they didn't pay a dividend, as we can see, and in fact they had plus 10% recession sales, above the average of the S&P, which was around negative 12. Now, as we can see, their dividend growth is fairly nice over the longer term. October last year, 4.7%. Remember, on this channel, we always advocate a minimum of 4% in that inflationary target, because over the last 40 years, the US inflation rate was 4%. If you're getting less than that, salary, dividends, or other income-producing assets, you're taking a pay cut and losing your purchasing power. Nice to know, over the last 5 years, high single digit. Over the last 10 years, double digit. We love to see that as dividend growth investors. Now, what we can note in fact here is they've got 52 years of consecutive increases. As we spoke about at the beginning, that makes them a Dividend King with 100 years of paying a dividend without a reduction. Now, very importantly, we always look at dividend yield theory. It does state a company is undervalued when the current yield sits above the 5-year average. So you could argue, based on this model, overvaluation, as well as the forward P 13.8 above the 5-year rolling of 9.7. But as always, we're not looking at any one of these models in isolation, and we will conclude towards the end of the episode. And we can see the healthcare sector P does sit higher at 16.2. So first and foremost, with our analysis on the metrics, we draw your attention to the free cash flow payout. Do consider the earnings is susceptible to manipulation by management through accounting. Below 50% is the target for biotechs. Pretty much since 2015, it has straddled around that. 48 in 2023, 53 anticipated in 2024. No issues whatsoever, looking good, and we can start to understand why in fact they have a safe dividend score. Free cash flow per share, very important. Invest in companies that consistently increase it over the longer term, and we see exactly that with AbbVie. 1.84 in 2014, 12.5 in 2023, although we do see a small drop expected into 2024. We then move on to the sales growth. Always important that you do aim for a minimum baseline of 3 to 7%. What we can see, pretty strong if you look at it from a long-term perspective, although the more recent year there was a drop of negative 6%, which we can say is the first drop to their top line over the last 10 years. And when you look at it numerically, in fact, they have more than doubled their top line over the last 10 years. Always a great sign. One thing that we would like them to see is do a lot more share buybacks. In fact, the point over the last 10 years would be share dilution. They have issued shares, increasing it from 1.61 billion to 1.77, but over the more recent years we can see very minimal movement to those shares outstanding. ROIC, one of my 7 golden dividend metrics, I want to see here 10% or more to give us faith that management are able to effectively allocate their capital. Again, if you want to be specific, 25% for biotechs, and they have pretty much straddled around that over the longer term as well. 24% in 2023, it does look good to me, and this is one that I'm satisfied with if I was an investor or even a potential investor looking to buy. Operating margin then above 25%, and we do see that over the longer term, in fact consistently above, but very inconsistent on a year-on-year basis. 33% looking healthy in the more recent year. Free cash flow margin very strong, in fact increasing over the longer term, in the low 40s over the last 2 years and on a trailing 12-month basis, so we love to see this from this free cash flow machine. Finally, we get your attention to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. We want to see below 1.5 for biotechs, and remember these numbers that you see below are the number of years it would take the company to pay off all of that debt net of cash on hand. It has been consistently above that maximum we want to see. 1.85 in 2023, 2.07, so a small increase anticipated, and probably why we do see the dividend score at around 80 as opposed to looking at very safe. So something just to consider for the future. So now let's move on to the valuation method for AbbVie, and as always, if you are enjoying the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now on this channel we do typically run through every single one of these models. Today's episode, it isn't a deep dive, so let's just go on a high level straight to the intrinsic value. And today's episode of AbbVie, we do get to $200, and in terms of the current price, around $160. We start off with our 10% margin of safety. Remember, we only execute on stocks at 10% if they meet our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, a margin of safety of 10% indicates a buy up to $180. At 15%, a buy up to $170. We keep going till it's essentially near the current trading price. And for today's episode, for AbbVie, we do have a 20% MOS level. In terms of Wall Street, well, they see around 16% upside over the next 12 months. Their price target is $186. And in fact, this is one that I do hold individually in my own portfolio. But let me know your thoughts as we go along, whether or not any of these likewise you do hold. Maybe you're looking to sell, or maybe these are now on your watch list. So the next Dividend King that we are looking at today is American States Water Company, with a buy rating from Seeking Alpha and a double hold from the other 2 analysts. We have this company that is towards the mid to lower end of the 52-week range. In fact, it has been hammered down 18% over the last year. However, if you have been a shareholder over the longer term, you would be up 138%. And it also has a fairly nice starting yield, 2.34%, and a forward P that is marginally higher than the S&P at around 24.4. Now, we have a very safe dividend score at 98, market cap just under 3 billion, making it a mid-cap company. And we can again see just in the last week that it was reaffirmed that a dividend cut for this company does look to be highly unlikely. Now, last recession, how did they perform? In fact, they increased it during the 07-09 Great Recession. They had plus 2% sales, remember, above the average growth, and they also outperformed the S&P negative 30%, S&P coming at negative 55. Actually, for this company, very strong growth, high single digit last summer, high single digit over the last 5 years, and the same to be said over the last 20 years. So nice consistency to that dividend growth, and we can see 69 years of consecutive increases. We then move on to dividend yield theory, and we can in fact see for this company a double undervaluation signal, both on the yield and on the forward PE. However, we do notice it is higher than the utilities sector at 16.2. Now, typically with companies, whilst we look at the free cash flow for utilities, a lot more volatile, so we draw your attention to the earnings below 75%, and that is what it has been consistently, 56% expected into 2024, so we can already gauge why this company has a very safe dividend score. Earnings as well per share, we do want to see consistent increases over the longer term. That is pretty much what we see. 309 anticipated. Again, the trend does look to continue into next year. In terms of the sales growth, well, this is a utilities company. Do expect some cyclicality, and that is pretty much what we see. In fact, 5 of the last 10 years, we do notice negative growth. 2023 though was a very strong year, 21% increase to their top line, and we can see over the longer term, whilst you could argue very minimal movement, do understand, have realistic expectations for those companies, and don't tend to look at other companies like tech that are growing fast and have those same expectations for all other companies in the S&P 500. In terms of shares outstanding, well, this is actually a very good sign. They have in fact got net share buybacks over the last 10 years. The reason why we say this, for utilities, they do tend to do the opposite, as you can see on other episodes that we do deep dives. So we would say this is a fairly positive signal. ROIC, well, we do lower it for utilities down to 7.5%, above that every single year, so already off to a great start with a lot of these very positive metrics. And we also note for this water utility company, not only above the 18% we want to see for water utilities in general, but it has got operational efficiency, increasing their margins to 33% from that 26 number in 2014. Now, when we look at the net debt to EBITDA, remember what that does. It does correlate to balance sheet strength and dividend safety. Below 5.5 for this industry. In fact, it has been increasing over the longer term, but 2023 at 3.87 was a nice drop from the higher number in 2022, and anticipate to be very familiar, or similar we should say, in 2024. So looks good in terms of all of these metrics. Let's take a look at the valuation model. As always, don't forget you can click on the pinned comment below, grab a copy of this valuation model to get to both intrinsic value as well as the acceptable buy price of companies in your own portfolio. 10% margin of safety pretty much indicates a buy at this price. A lot of people will like the stability that utilities companies does give their portfolio, but as always, let me know your thoughts. Maybe we can do some deeper dives on utilities as general, or maybe it isn't an area that you are looking to consider for your own portfolio. What we do notice, however, is that Wall Street does see a lot more upside than our intrinsic value. Their price target, $87, 18%. So in conclusion, a 10% MOS level for AWR with 18% upside projected into the next year from Wall Street. Then move on to the next Dividend King. We have Lowe's company. Now this is one where we have a buy rating from Wall Street, a double hold from the other two analysts. It is trading in the mid to lower end of the 52-week range with a forward yield of 2.08% and a forward P 18.09, significantly lower than the S&P. It is up around 8% over the last 12 months. If you've been a long-term shareholder, well, you would be up 355%. When we take a look, we can see a very safe dividend score, 93, market cap 126 billion. It is a mega cap company, and we can see in March it was reaffirmed a dividend cut does look to be highly unlikely. So what about the last recession? Well, in fact, they increased the dividend. They had above average growth, but they did have a near S&P return at negative 52%. Now, this May was very disappointing. In fact, just a few weeks ago, their dividend increase in line with inflation, due to the fact that over the last 5 and last 20 years, we have been used to some very strong double-digit growth, but we can see they are a dividend king, 63 years of consecutive increases. Now, in terms of dividend yield theory, we do get that undervaluation signal on the yield, and we also note the forward P is marginally lower than the last 5-year average, but we also note consumer discretionary, 14.7, is lower as a sector than Lowe's. In terms of the free cash flow payout, well, what we can see below 60% as the rule. So remember, we're looking for 60% or lower to give us faith management can offer those double-digit increases we love to see. And in fact, it's been below that consistently. 41 in 2024, 38 in 2025 expected, so no worries with that there. In terms of free cash flow, with the growth that we want to see, it has remained fairly flat, in fact decreasing just over the more recent period, although we do anticipate a nice increase into the full year 2025, but over the longer term we do see it has more than doubled. In terms of sales growth, well, other than the more recent year, it hasn't been too bad, but we do have to point out 2024, their latest annual accounts was a massive negative 11% drop to their top line, and if you do take a look at it over the longer term, they have been increasing their revenue. One thing we love with this company are those shares outstanding. They are doing a lot of buybacks, as we can see. It is a very consistent theme with this company, and one that does return excess cash by giving you a larger portion of the company. In terms of ROIC, well, very, very nice to note, not just above that 8 to 10% level, but it has been increasing over the longer term. And in fact, in the last few years, at the very high to 50s, it does look very good. Even the 43% on a trailing 12-month basis is very attractive for investors. In terms of operating margin, they have had some years where they have struggled below that 12%. Nice to note the last 3 years pretty consistent as well as on a trailing 12-month basis, and the same to be said for the free cash flow margin. This isn't a company with massive margins on the operating or free cash flow, but what you do get is a lot of consistency year on year, as well as above the minimum targets we want to see. In terms of the net debt to EBITDA, well, it is below 3. That is always a positive. 2.78 in 2024, expected to go a little bit lower to 2.7. That coupled with the fact that the free cash flow payout is fairly low, no worries with their dividend, and hopefully next year we can see a larger increase as we have seen from this company typically. In terms of the valuation model then, what we do note from this company, the intrinsic value $265. With a current price of around $217, our margin of safety at that 10% level indicates the buy up to $239, at 15% $226, and we keep going, and what we can see, not at a 20% MOS level yet, but between a 15 to 20%, which some people could find sufficient, although I know a lot of people in the community also love the Home Depot as an alternative. In terms of Wall Street, well, they anticipate $260 for the price over the next year, with a 20% upside as well, so it does look like one of the more attractive Dividend Kings to consider for the portfolio. We then move on to a fairly new Dividend King. It is S&P Global with a strong buy rating from Wall Street, a buy from Seeking Alpha, and a hold from Quant. It is trading towards the upper end of the 52-week range, one of the lower yields we've seen today at 0.85%, as well as one of the higher forward Ps at 30.2. Over the last 12 months, though, it is up 17%. Over the last 10 years, some very strong growth, up 415%. In terms of dividend safety, well, the highest score obtainable, 99, it does look to be safe. Market cap, 134 billion. It is a mega cap company, and we can see again, it was reaffirmed not too long ago. Dividend cut does look to be highly unlikely. Now, last recession, they increased the dividend, but they did have negative 38% recession sales, which was massively below the average. And again, very similar. What we do notice here, like Lowe's company, a very poor increase in this year, especially when over the last 5 as well as the last 20 years, we have seen double-digit increases. As we mentioned as well, they did become a Dividend King this year. So let's take a look at dividend yield theory. What we do note here is reasonable valuation on the yield as well as that on the forward P. But when we do compare it, the financial sector is significantly lower at 11.4. But do bear in mind there are a lot of companies in here that aren't that high quality, bringing this P right the way down. In terms of the free cash flow payout, well, below 60%. In fact, it's been pretty much below that 30% for the majority of the last 10 years. 32% in 2023, expected to go to 22% next year. So ideally, we can see a nice double-digit increase January in 2025. What you get here is quality with the free cash flow. It has been increasing over the longer term. In fact, nearly 3 times. 2024 expected to go even higher. So lots of positivity for the next full financial year. In terms of the sales growth, well, lots of very strong growth. In fact, double-digit growth over the last 4 years, 7% on a trailing 12-month basis. And even just prior to that, we are seeing some very strong numbers at a bare minimum at the upper end of the 3 to 7% level. And as we can see here, more than doubled their top line over the last 10 years. Now, they did have an acquisition, which is why we do see that increase from 21 to 22. Otherwise, the natural trend for this company is to do those share buybacks, and we can see a very small amount from 23 to 24 latest period. We then move on to the ROIC, very strong numbers from 2014 to 2021, but the acquisition has affected these ROIC metrics. Prior to that, we do see it in the 40s, trailing 12-month basis though at 9%, moving towards that minimum 10% target that we want to see. In terms of the margins as well, above 12%, it is above that. It has dropped, but it is looking from 2022 lows to go back up 38% on a trailing 12-month basis. And the same to be said for the free cash flow. Over the longer term, very strong numbers, 31% on that trailing 12-month basis as well. And when we look at the net debt to EBITDA, 1.86, pretty much an all-time high in terms of that metric. Looking like it's coming down not just in 2023, but also anticipated in 2024. Also makes sense then, coupled with that free cash flow payout, why essentially the dividend has the safest score obtainable. So let's jump into the valuation model. Don't forget you can grab a copy of this by clicking on that pinned comment below and running your own numbers through. So current price then, 10% margin of safety indicates a buy up to 449, at 15% a buy, not too far off, nearly $3 away. So we would say that S&P Global has around a 15% margin of safety in today's episode. In terms of Wall Street, when we do take a look at their numbers, their price target not too far off our calculated intrinsic value of 16%. They do anticipate 495 to be the trading price in around 12 months' time. Now, as we said at the beginning of the episode, there will be a lot of people who maybe are worried about dividend cuts and maybe looking to put their money into an ETF. And for those that are specifically looking at essentially ETFs that just have Dividend Kings, we do have a fairly new one. We have covered it before, but as a refresher, it is KNGS as the ticker symbol, and as we mentioned, it does hold over 30 companies that are Dividend Kings. Now, one of the reasons why you may be looking to add this company, as we can see, elite dividend growth is what they say, although do bear in mind, over the last year, a lot of these Dividend Kings have only increased their dividends very marginally, not like they had over the last 20 years. They talk about how they are blue chip leaders, as we are about to find out these companies in terms of their holdings, and they do have a lot of defensive qualities. Maybe you won't see a lot of market upside, but you will with this get a lot of smaller drawdowns when there is mass volatility in the market. In terms of the expense ratio, this is definitely something to keep an eye on, 0.35%. We wouldn't say it is overly high, but also it isn't towards the lower end that we ideally like to see. And if you want to find out essentially the companies that are in here, their top holdings is Black Hills Corporation, over 5%. We then have Sunoco Products at just under 5%, Federal Realty Trust around 4.56%, and a few others which I'm sure you have heard of. The one thing to note here is that previously 3M was within this ETF. However, after their dividend cut, again, an episode we have done a deep dive on, this has now been removed. Whether or not you are happy with that, this is just something that has to be done, given that this is purely a Dividend King ETF. Now, finally, in terms of the performance, like we said, it is a fairly new one. What we can see though, since inception, this is up around 16%. Whether or not that is sufficient for you, you can see over the longer term, this is one that hopefully will be very strong. But as always, it does come down to the individual investors. Right now, it's trading around $27.63. If we were to go back to around November, you can see $25. So as always, it does depend at which point you did enter this ETF. But let me know your thoughts below. Is this one you are looking to add as well alongside individual stocks? Maybe it's one you've considered, but you personally prefer other ETFs like the S&P 500 or high yielders that don't specifically cover Dividend Kings, which you could argue maybe have slower growth than other ones that are increasing, potentially like Dividend Aristocrats. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts in the comments below, and as always, we'll see you all on the next one. And just as a reminder, do click on that pinned comment below, sign up if you do want to take a look at our 12 undervalued dividend stock, high quality companies. We do run through a lot of information, all free, and it gives you access to other articles as well. As always, see you on the next one and take care for now.